Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on ServiceNow. Is this digital workflow growth company still worth investing in? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your long-term growth investors and your short-term investors out there. And as always, folks, don't forget to smash that like button down below and consider subscribing and hit that notification bell like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. This video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you will get 2 free stocks by using my referral link in the description below. So definitely click on that to open up your account. Okay, so ServiceNow is a digital workflow company. The company cloud-based platform and solutions deliver digital workflows for employees and the enterprise. Now, the company's products portfolio includes the Now platform, and standardized applications designed for automating information technology, employee and customer workflows. It also includes creator workflows, which support custom workflow creation, application development, and integration with third-party systems through ServiceNow Integration Hub. Now, the Now platform is a single cloud platform with one data model and one architecture. Now, the Now platform powers 3 native mobile experiences for everyday work across the enterprise: a virtual agent, a Now mobile, and mobile onboarding. Now, the company delivers its software through the internet as a service. It markets its services to enterprises in a wide range of industries, including government, financial services, healthcare, manufacturing, oil and gas, technology, and education. Now, let's go ahead and look at some of the news of the company right now. The other day, CEO Bill McDermott wants to take the company to a new era and is very ambitious for these plans. Now, he wants to make the world of work better for people. He wants ServiceNow as a platform of platforms, he said. He explains that the experience is everything and wants to capitalize on the workflow revolution in the enterprise. His lofty goal targets is tripling the ServiceNow revenues to $15 billion over the next 5 years. And in this analysis, we're only going to project the next 2 years. It's hard enough to project that than to go after a 5-year projection, but it's good to have goals. Now, ServiceNow's compelling proposition is that it has been able to plug into existing systems of record and make workflow more easily across an organization, modernizing aging systems with a new engagement layer that speaks across all the silos. It was also announced that ServiceNow and Celonis have a strategic partnership that aims to help organizations get the most out of their systems of record, allowing them to isolate bottlenecks in their processes and automate workflows. Now, ServiceNow also has intends to make a financial investment in Celonis, a company which specializes in deep process mining. Now, according to this article, the partnership has the potential to be very interesting. ServiceNow has long positioned itself as a platform of platforms where it seeks to bridge the gap between existing systems of record and help workflow through an organization. With the Celonis tie-up, it appears that ServiceNow is taking this further, where the integration with Celonis process mining capabilities will see the Now platform go deeper into companies' ERP and CRM systems, for example. Now, these jointly developed solutions will reach the market in the first half of 2022. I think this is a great partnership, and I will get into the detail back into that in a bit. But for right now, let's go ahead and look at some of the fundamentals of the company. So the share price currently is trading roughly around $692 a share right now, with the market capitalization of $139 billion. The expected revenues by the end of 2021 should be roughly $5.87 billion, and they have a projection in 5 years of 15. So, and they have the earnings right now, it's projected to be by the end of the year $235 million. Now, revenues are expected to increase year over year, and by 2023, 2 years out, it's projected that they will be at $9.17 billion, with earnings projected to be around $561 million. That makes ServiceNow to have high growth revenues and earnings that are expected to grow significantly over the next 3 years. Now, ServiceNow has become profitable over the past 5 years and growing the earnings about 65% per year. But please note that ServiceNow has had negative earnings growth over the past year, but that's projected to get better over the years to come immediately. And looking at ServiceNow ServiceNow's current net profit margins, it has been 4% right now, and that's lower than the past years of 16.6%. Now, ServiceNow's return on equity is forecasted to be high in 3 years' time, about 30.5%. Now, good news is ServiceNow's short-term assets of $4.3 billion exceed both its short-term liabilities of $3.8 billion and its long-term liabilities of $2.2 billion. And its debt-to-equity ratio of 44%, though, is considered high, but it has been reduced over the past couple years from 137% to 44% over the past 5 years. Now, its debt is well covered by operating cash flow of 128%, and the interest payments on its debt are well covered by EBIT. So let's look at the valuation analysis. Now I'm going to bring it back here. Now, because ServiceNow is in the software industry and has positive earnings, the PEG and PE ratios are the most appropriate valuation measures. Now, the price-to-book ratio is excluded since it underestimates the company's book value by overlooking hidden assets such as intellectual property. Now, the price-to-sales ratio is not as meaningful as the PE or the PEG ratio due to the company's positive earnings. Therefore, ServiceNow seems highly valued with a PEG value of 24.5 times, one of the highest in the software industry, which is supported by a price to earnings ratio of 643 times. That is among the highest in the industry. Now, looking at the profitability analysis, based on its operating gross and net margins, ServiceNow converts above average median percentage of its revenues to profits compared to other companies in the software industry. Furthermore, the company is profitable with an operating margin of around 4.25%. Now, looking at the growth rates analysis, it saw earnings decline in spite of positive revenue growth in the past 12 months. Additionally, the average company in the software industry was able to improve its earnings result over the same period. And looking at the financial strength analysis, its debt to total capital ratio of 30.8% is in line with the software industry's norm. The company should be able to comfortably repay its debt given its interest coverage ratio of about 33 times. So what do the analysts say about this one? Well, the analyst consensus right now is a strong buy, with 25 saying buy and only 2 saying hold, with none saying sell. The average price target is around $744 a share over the next 12 months, with a high as much as $820 a share and a low of $650 a share. And going over a few of the analyst reports, though, now the New Constructs report recommends investors avoid ServiceNow right now and give it an unattractive rating, which they say has more downside risk than upside potential. Now, they said the price, the economic book value, is unattractive. That measures no growth value of the company based on current net operating profit after tax, and they say the growth appreciation period is also very unattractive, which means the level of market expectations is high, and there is a big difference in the expected financial performance implied by its current market price and the company's historical performance. Yes, I do agree with them that the company is overvalued and has future profits baked in, but we have to look at, really examine if we believe the future prospects look good or bad, and I will get that in a few. Now, the Street Quantity Ratings ServiceNow as a buy. This is driven by some important positives which they believe should have a greater impact than any of the weaknesses and should give investors a better performance opportunity than most stocks they cover. Now, the company's strengths can be seen in a multitude of areas such as the robust revenue growth, largely solid financial position, and reasonable debt levels by most measures, increases in net income, good cash flow from operations, and solid stock performance. Now, they feel that its strengths outweigh the fact that the company has had somewhat disappointing return on equity. And going to the Ford Equity Research Report, they have a hold recommendation on ServiceNow, and it's the result of their systematic analysis on the 3 basic characteristics that they look at. They look at the earnings strength, relative valuation, and recent stock price movements. Now, the company has produced a positive trend in earnings per share over the past 5 quarters, and while recent estimates for the company have been mixed, ServiceNow has posted better than expected results based on operating earnings yield. The company is overvalued when compared to all the companies that they cover. Share price change over the next year indicates now will perform very poorly over the near term, and I'll get into the near term and my thoughts on it. So, am I a buy, hold, or sell recommendation on ServiceNow? Here are my thoughts. Now, fundamentally, the company is sound, even though it's trading way over valuation. Investors have already baked in and priced in future potential profits in its share price. This makes it going to be a highly volatile growth stock in the future. For me to evaluate this company, we have to look into the future and put my future goggles on and say to myself, do I believe that ServiceNow will succeed in their ambitious goals? For instance, the company's compelling proposition so far has been its ability to plug into existing systems of record and make workflow more easily accessible across an organization. They modernized aging systems with a new engagement layers that speak across all the different silos. I, among everybody, recognize the benefit of touching all areas of an enterprise without the need to rip out and replace outdated ERP, CRM, and HR systems. Now, looking at their partnership with Celonis and recently acquired GeekoBrain, now ServiceNow is creating a digital control center. Think about a control center with different modules attached to it. And this is going to be a really great thing. They want to modernize the 20th century architectures for all these different enterprises. But the point of all this is I believe they're bringing value to customers and the competition to get the most money out of their investments. And ServiceNow is at the forefront of reducing the complexity of IT infrastructure that started way back in the Y2K era and ended up with a multi-cloud super complex systems that are going on right now, where executives said, hey, let's put on the brakes and see what's going on in our organization. We're fragmented all over the place right now. I'm one that believe that the digital control center that will fuse IT infrastructure and the business all in one is the only approach companies should look for in the future to attain. But let's step back and say those are lofty goals and all. And as an investor, so I'm going to put my investor hat on. I have to examine, does one believe that ServiceNow can obtain those goals? I, for one, am a believer in the CEO that took over the company right now over the past couple of years. And I believe they're at the critical step right now with all the great traction that they have attained to date right now. We also have to look at stickiness. Once a vendor has multiple tentacles around a consumer or business, that consumer or business tends to stay, and because there's less fragmentation across the organization to deal with all over the place. Think of that digital control center I was just talking about, and adding like, here's an HR module, here's a CRM module, and all these little different modules to interconnect with the business. So based on all of that, I'm a long-term bull on ServiceNow. I have a 12-month price target of around $750 a share. I would buy on the next dip though. I would say around, wait till it gets around $650 to $675 a share and hold for the long term. I think this should be in everyone's growth portfolio, and I think it definitely will outperform the market in general. I do believe in their goals, but short-term investors could play the swing dips on this one and make a decent profit. Now let's talk about some downside risk to my bullish opinion about ServiceNow, okay? Because we got to take that in consideration. Please take in consideration that it's trading way above its valuation measures, and the current price has future profits. I've said that over and over again, but I just want to reiterate it. It's baked into the stock price, which means any negative news will create volatility in this stock. I would closely examine the quarterly reports that come out, because if they start missing their revenue and earnings projections, there might be some future pullbacks of the stock. So really closely look at those reports and find out exactly where those revenues are coming from to see if actually you believe they're going to hit their targets for $15 billion over the next 5 years. That being said, I do have faith in this company, and I'm betting good things for ServiceNow for this year, the next year, and 5 years beyond. And I hope they succeed at it. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing and hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.